You have an outperform on ASEAN nations, but more on nations that focus domestically and on domestic demand. Given how exposed externally Singapore is, what do you make of what's happening in that economy, and how do you rate it as a market player?
I think the Singapore economy is likely to do quite well for the next 6 months at least, largely because of the fact that, the domestic reopening has actually been pretty good. And we were, like you said earlier on, we're seeing a lot of tourists, we're seeing the MICE industry coming back to life. And that on a shorter term basis is likely to actually bode pretty well for us. But in terms of competitiveness, where the tourism dollar is concerned, that might have an impact, a negative impact in the future, largely because, the Sing dollar this year has been one of the best performing Asian currencies, so to speak, and therefore that might make us a little bit more expensive compared to the rest of the region. And of course, with the collapse of the Aussie, the Kiwi, and the rest of the currencies as well, with the exception of the dollar, Singapore becomes a pretty expensive destination in that sense. So on a short-term basis, yes, growth is going to be strong, but I think sometime next year, the higher interest rates and the stronger currency will probably factor to a certain extent where economic growth is concerned.
Yeah, talking about the weaker currencies, really, Japan can't get a break, right? I mean, we had so much volatility overnight. We have BOJ Governor Haruhiko Kuroda speaking in D.C. again today and doubling down on that loose monetary policy. How do you rate a market like this when you have a Japanese yen that continues to be under pressure because of rate differentials, and it doesn't look like it's going to change anytime soon?
Yeah, I don't think that's going to change anytime soon, not until we get a new governor in any case. But the strange thing about Japan is that the currency intervention is done by the Ministry of Finance, which obviously is not in tandem with what the BOJ wants. Governor Kuroda has said on many occasions that he's going to keep monetary policy where it is. He's not going to do anything about the yield curve control as well. That basically means that the gap between the dollar yields and the Japanese government bond yields will increasingly widen. And after last night's CPI data coming out from the US, you probably bet that the Federal Reserve has more room to actually increase rates in the next couple of policy meetings. And now, increasingly, the narrative is likely to shift to whether it's going to be 75 or 100 basis points in November, and perhaps another 75 in December as well, leading into 50 in January. That kind of move is likely to actually widen dramatically the gap between the Japanese yen and the US dollar.
Does it change the differentials when it comes to Asia, though? Because with more of those moves from the Fed, that increases the threat of financial stability concerns, and that obviously impacts the banks. Would you be preferring the Asian banking names in this environment?
Yeah, well, the Asian banking names are sound because of the fact that they are very well capitalized. And on top of that, the Asian banks have a very wide deposit base, pretty big deposit base. So that means that the net interest margins are likely to actually improve further, given the fact that most of them, the economies are still doing pretty well, they're not in a recession, and therefore they don't really have to hike up the deposit rates in order to get more deposits coming in order to boost their lending. So I think from that perspective, the Asian banks are in a very, very good position, but in particular the Singapore banks and some of the Hong Kong banks as well. But the problem is, at some point, the economy will slow down because of the fact that your rates are too high, and you just can't be asked to borrow anymore. I mean, how can you borrow and to fund expansion if the rates that you're borrowing is going to be at about 4.5% to 5%, and global economic uncertainty is actually starting to set in. So I think in the next 12 months, I think things are actually okay. But I think beyond that, the picture gets very, very murky.
How constructive are you when it comes to markets like India, given that we are expecting to see more outflows, particularly with a more aggressive Fed, and one assumes an even stronger dollar?
Yeah, India is going to be a tricky market because, earnings revisions downwards, I don't think they have actually peaked yet. The high inflation, the higher interest rates go, that's going to actually affect the earnings of these companies listed there. India is not a net exporter, it's a net consumer market. So you need to watch the consumption patterns very, very closely. And I don't think that's likely to be positive in the next 6 months, given the fact that your interest rates are rising and there is no way the RBI can actually prevent that from happening, not with regards to what's happening with the US at this point in time.